for bias purposes, I'm looking for this as a draw on liquidity. So if we have a bias in mind, then obviously it makes good sense to try to focus on setups that would allow us to tape read or demo trade. See how I segued into that, not live trading. The idea of following price action with that narrative, it helps build continuity. It will reward you with sticking with the higher time frame premise, which is a daily chart here. And if we then flesh out the ideas from the daily chart and also remind ourselves the conditions that we're in high resistance liquidity run conditions. High liquidity run conditions are when the market stays many times in the same previous candles range. And just for clarity's sake, look at what we did today. Today's range basically is an inside day. This is Friday's day, high, and day low. But just inside, I'm sorry, just outside of the low, but the body stayed inside of the previous day's range. Okay, so there's two versions of an inside day. You have an actual inside day where today's day, highest high and lowest low, is lower on the low the previous day, and the low of today does not go below the previous day. In other words, general practitioners of classic support resistance type trading, okay, they will use previous high, previous low. And if there's a day that forms where the entirety of the day's range, the highest high and the lowest low, is not beyond the previous day's range, as previous day's high and previous day's low. Okay. So previous day's high and previous day's low. Today's high is lower. So we were not able to trade above previous day's range. So it fell short of previous day or Friday's daily high. Today's actual low did in fact trade below Friday's low. So we're slightly lower. See that? But here's where the curveball comes in, ICT style. This range, okay, see this range, Friday, the body of the candle for today's trading is inside Friday's range. So yes, the wicks are allowed to do the damage. It explored below Friday's low. That's fine. But it's also telling me that we are in a compression. And when the market's compression builds up over days, okay, smaller ranges, inside days, what happens is it creates a release where it's just springs ahead and goes either higher or lower. I'm bearish on NASDAQ. I expect lower prices. Now, if we take out this high here, then I'll revisit the idea of whether or not that's right or wrong. But for right now, until this high is taken out, I'm sticking with that idea. I gave you a very specific reference point on the daily chart, our fair value gap. Okay. So I said, watch this one here. It could trade up into that, but ultimately, we only saw one little deviation outside of this range with this close, which was a little, a little concerning from a precision stance if we weren't trading in this high resistance liquidity run condition where we're staying inside of inefficiencies longer than we should. If it was low resistance liquidity run conditions, that means we will see volume imbalances, we'll see fair value gaps, we'll see protraction, one-sided big range candles going one direction, and then any candle that goes against that underlying direction will be small bodies, and then small little retracements, short-lived retracements, and then longer protractions with larger candlesticks and the longer duration of price runs, number of candles, in other words, will be moving in one direction. Notice that we're just staying inside this range here. So we're in high resistance liquidity run conditions. That means it's not in a hurry to go anywhere. And that's typical at the beginning of the year. So by having these levels here, inside days are either today's high is lower than previous day's high, and today's low is higher than previous day's low. That's the classic rendition of an inside day. I will look at this view of today's price action as an inside day because of the body. The body is inside of Friday's low to high. See it? Okay, so this in and of itself is a PD array. It's a very specific perspective on me anticipating a measure of protraction, movement, something that's coming that I think is rewarding for a short term or a day trader, where we will have sustained price runs in one direction. That's what I expect. So in tomorrow or Wednesday's trading, I suspect that would be a likely scenario. Now, how does that translate to what I've said so far here? I would very much like to see a expansion to the downside and explore this low here. I'm not interested in seeing prices go higher. So it's this low here, and then eventually, with this idea in mind, which is these relative equal lows, as I mentioned earlier in the year when we started discussing NASDAQ from the daily perspective. Okay. So these are the levels that I'm watching. And now because we have this wick, you see this wick right here? That's a discount wick, and it's the opposing side or discount side of the market reaching lower that we would have to consider this range here. So you would take this, grade that. And for the folks that want to know what my fib settings, okay, so just take a screenshot of that, and that way you'll be able to address your Fibonacci the same way as mine. All right. And so consequent encroachment midpoint here, I would like to see it trade down below that and close below that. If it closes below that, discount wick, generally, not all the time, generally, it's indicative of a continuation in that direction. If we fail to get below the midpoint of the wick on a closing basis, that usually indicates that we're going to stay in high resistance liquidity run conditions, and that low will not be explored, at least for right now, until consequent encroachment level is breached by a closing basis. But as soon as we get a close below that, then I would expect prices to start having very long, like these big black down candles like this, big black stretched out limousines. The place to be is this low, and ultimately Club 64 down here. So right there's One Night Stand City. That's where you want to get to eventually. That's how I'm looking at it. I want to see it gravitate there. Everybody wants to go there. And that's what we're looking for continuation. So there should be no question as to what I'm expecting here based on the daily chart. Now, if we happen to expand to the upside and take out this high, it can do it on a wick simply because of the volatility that we're in right now. But it need not close above this. If it closes above that, then I'm absolutely going to be considering myself wrong, because it may in fact try to gravitate towards this high here. So that would be like the early warning sign. But it can go up here on a wick basis and then come back down. And if it does that, it needs to start respecting this fair value gap. But admittedly, I would rather it not do that at all, because we have a really nice swing high here, because we have Thursday's high there, Friday's high higher, and it also took out this little short-term high. And then today's high was lower. So a swing high is simply just 3 candles or 3 bars, with the one in the middle being the uppermost, and then 2 lower highs to the left and right of it. Okay. So it's 3 candles entirely. So now we can drop down into a 15-minute time frame. Just get a lay of the land because it's a bellwether chart time frame. And today is Monday, so this right there is midnight. So we rallied back up into this inefficiency here. New week opening gap. Couldn't even get to it there, so we'll just annotate that just for the sake of completeness. This is the new week opening gap. Notice the run this morning, which we will get into that. And I'll show you the setup and the signal and whatnot, and the other places that you could have taken a trade. So new week opening gap, we rallied up this morning at 9:30. We couldn't get there, failed, but we did take out buy side here. This inefficiency right there, we have a change in the state of delivery with this order block opening price there. You see how we revisited that? Hit it, hammered it, laid over top of this SIBI with a volume imbalance on a low. So that's this low to that candlestick's open right there. Premium SIBI with buy side running up into that. And I'll give you some tips on SMT today as well. So we have buy side taken, tagged, and then we have sell side here, and then sell side here. This is what we're doing pre-market. We're looking at these levels. We're looking at the potential of these levels being drawn to. So it's this, and then it's this as well. So we have sell side here and sell side there. Changing the state of delivery, new week opening gap. So what we do is we anticipate the likelihood of the market wanting to gravitate to, at the very minimum, this buy side, because 9:30 opening bell and opening range, which is 30 minutes, and it will protract to take buy side, close proximity buy side, close proximity sell side, and then the real move will ensue. So with this idea here, we can now flesh out a lower time frame. We'll go down in 1 minute. These levels over here, that orange box up there is the new week opening gap. We'll just do this. We'll make it a dark gray. Okay, so that's new week opening gap. The previous settlement here, that candlestick's close, that's today's regular trading hours opening range gap high. The low, because while we were watching price action, it's going to open up down here. And as you can see, it does that very thing at 9:30 on this candlestick right here, that opening price. Okay. And that's what's highlighted here. So because that's lower than where we settled at last Friday on regular trading hours, remember, look in the lower right-hand corner. That's regular trading hours. You're going to see the disparity between where regular trading hours begin at 9:30 Eastern time versus where we stop trading on regular trading hours previous session or previous day. In this case, it's previous week because it's Monday, and last trading day would have been viewed through regular trading hours on Friday, and it closes at 4:14 p.m. as you can see at the bottom of the chart at the time axis. Okay. So with that, we have several things here. We have several things. We have the idea of reaching for the new week opening gap. We have the idea of reaching for buy side liquidity, because that's the Judas swing, that's the manipulation, that's the fake out move, that's the trick to induce buyers to come into the market with it's heavily handed for lower prices. Okay, so in other words, smart money is engineering buy side liquidity to be rated. They absorb that buy side liquidity to be counterparty to it and sell short with the vested interest of seeing it trade to lower price lows where existing buy stops would be resting so they can buy at a lower price. So now because we have these levels here and we're going to grade the regular trading hours, opening range gap. Let's go down into the electronic trading hours. Okay, and here we are at the first few minutes of trading. And all the levels I've covered here, just know that every level I've just covered is here in the chart now. Okay. Those that are annotated with like Thursday's regular trading hours opening range gap high, Thursday's regular trading hours opening range gap low, those levels are the same procedure that you watched me just do today for Monday's trading. So how we came to Monday's regular trading hours opening range gap high and Monday's regular trading hours opening range gap low. Wherever the price is at 9:30 Eastern time, relative to where we closed on the previous trading day in regular trading hours at 4:14 p.m. Eastern time, if where we're about to open up is above the previous day's 4:14 p.m. Eastern time, if it's above it, then we're opening with a premium gap, and that means 9:30's opening is going to be the regular trading hours opening range gap high. But a couple minutes before 9:30, if price is below previous day's regular trading hours close at 4:14 p.m. Eastern time, then we're opening with a discount gap. That means 9:30's opening price will be regular trading hours opening range gap low. So we have at 9:30, the market opens up and it's attacking buy side liquidity, which are these relative equal highs. And then we have that change in the state of delivery on the 15-minute time frame. That's this pink line right here. It trades up into that. You see that? So what are we doing here? We're getting a higher time frame premise. I'm giving you an entire complete trading model today, in case you haven't noticed that. We're going from a daily chart and we're trying to get a feel for where it's likely to draw to. Where is it likely to draw to? Not just for today, but on a longer scale price run. What is it likely to go to? Where's it drawing to? Don't be afraid of being wrong on that daily chart. There's going to be lots of daily candles that go against this idea. And traders that are brand new or students that are brand new to this idea, they get their, you know, emotions all whacked out because they have a day that just screams against that and they think, oh no, I better change my bias. I better change the way I'm looking at this. I'm probably wrong. And by constantly referring back to the daily chart, it'll keep you in focus so that way you're not going back and forth intraday, buying and selling, and second guessing your higher time frame premise. Okay, so my bias is bearish on NASDAQ. My premise is it's likely to start seeking lower prices now because we have an inside day on the body basis. Today's body of the daily candle is inside of Friday's range. So I'm expecting tomorrow or Wednesday's volatility to start showing one-sidedness and big down black closed candles. So changing the state of delivery, we watch and see because it could go up into that gray box. Why? Because Monday's regular trading hours opening range gap is last Friday's 4:14 p.m. Eastern Standard Time regular trading hours closing price. That's what that price is up there. That gray box is new week opening gap. So there's two things that could lead to this gravitating towards that going up there. Okay. The buy side's here, it runs above that. As soon as we hit the change in the state of delivery, I'm looking at this up close price. That's rejection block. I'm going to wait for that to trade below it like we do here. And as soon as we get that here, I'm hitting that, and my stop loss is going to be mid new week opening gap. One contract. One. And then I would look to build another entry in it. Here we have 9:30 opening. So that's the opening price at 9:30, which also is, in this case, Monday's regular trading hours opening range gap low because 9:30's opening price is lower than that last Friday, 4:14 p.m. Eastern Time's closing price on regular trading hours. So once we started to drop off, it could still run that high. And as we're seeing it run up here, watch what happens. This high here with ES, what do you see different here? NASDAQ had a lower high. See that? ES was pushing higher. It was pumping it higher, higher, higher. So this is SMT. So for your notes, when is there a high probability for efficiency using SMT related correlated asset analysis? In other words, you're looking at ES versus NASDAQ. When is that appropriate? When am I even considering it? When there is a liquidity run or a high volatility injection like news. Okay. 9:30 is always going to act like that. 9:30 is running liquidity. The first few minutes, first 30 minutes, we're looking for liquidity for it to gravitate towards. In this case, we're seeing that Judas swing higher at 9:30. Here's 9:30's candle. It rallies up and it makes a high, higher high, higher high. Bull flag traders are going to look at that and fall in love. That's my Valentine. Kissy, kissy. But this is the kiss of death because we're going to go back to the NASDAQ. See that with open, high, low, and close. It's a very simple procedure. And see how it made a lower high here? So now, when do I use stop orders to get into a trade? Or when do I mark it in when I'm watching price action trade to and through a specific level? In this case, Cameron was prompted to watch that candlestick's opening price right there. When price was rallying up like that, I told him, I said, as soon as you see it trade through that opening price, as soon as you see it, enter at the market, sell your 2 contracts of micro. But as soon as he put the order in, I said, now it's going to drop a little bit, give it a chance to drop, and then you're going to put your stop loss just below the opening price because if it's going to run, it's going to rip through it real quick. So now what I'm teaching him is sharp reversal patterns, and this is what we're covering today. Okay, so the topic today is sharp reversal patterns and using stop orders or market orders, not limit orders. So when am I doing that? Here we're seeing an SMT divergence. We have the change in state of delivery traded to on the NASDAQ. This high here, I'm going to see it fail. I don't need to get up here and short it. I don't need to do that. But I would have already been short on this candlestick right there with a stop loss at mid new week opening gap. If I would have got stopped out, no problem. I would have been waiting for another setup to see it break down and look for some kind of a fair value gap, some kind of institutional order flow entry drill, something that affect a bearish breaker. I would have looked for it to then also present a SMT divergence up here. If you're looking for SMT and it's not occurring, or if you're not looking at it at a time when liquidity is being taken with the express interest of it likely going another direction, opposite direction, or if you're not using it at the opening range, the first 30 minutes, you're probably looking for SMT in the most inopportune times. SMT is wonderful, folks. It's a wonderful idea and concept, but there's a place for it, and it's not in every setup. So if you want to use SMT, it's just the divergence between closely correlated pairs or assets. So if it's Forex, the same thing there. It's liquidity or opening ranges. So it breaks below that price, and look at the excitement lower. Boom, lots of animation. And where did it run quickly for? Those stops right here. That's exactly what you want to see. You want to see that. Now, when that occurs, do we want to see this entire gap here fill in and do any kind of patchwork over that? No. We want to see a small portion of that left open. So this gap here, there's consequent encroachment of it, and we can grade that also. Now watch, this is the purpose of having all those levels on your Fibonacci. The bodies, notice that they cannot even get back to consequent encroachment, which is the midpoint, 0.5 level. The wicks are allowed to do the damage, but it went through consequent encroachment. It went through the 0.625 level, but it could not get to the upper quadrant 0.75 level. You see that? Failed to get there. But then reversed and the bodies were below mid-level, consequent encroachment. That right there indicates weakness. It means expect it to eventually work its way lower. Here we have another attempt to get up into it, but now look what this does. It doesn't even get to consequent encroachment at all. Now we have a lower high in deference to this high inside of this inefficiency. No bodies of the candles are allowed to be laid down in the upper half. That's real institutional order flow. So this drop down here, notice these relative equal lows here. So these relative equal lows is sell side, and then you have these as well. So it failed to make a close with the body above consequent encroachment. It failed to touch the consequent encroachment there. So we have a lower high. So now we would anticipate what? More protractions to the downside. We have sell side now that was engineered here. And then we have last Friday's regular trading hours opening range gap high. Last Thursday's regular trading hours opening range gap low. Tuesday's regular trading hours opening range gap high. Look how it used it right there. Went below it, came out, hit it perfectly. So it hits it here perfectly. Bang, hammers it. What time, baby? What time did it hit that? During a macro time. So it trades down into some old random levels, but it leaves Tuesday's regular trading hours opening range gap low. It leaves that intact. And then we pull off of that, come back down, touch Friday's regular trading hours opening range gap low. So do you see what I got here? I have a couple days worth, a week's worth of the opening range gap levels. That's the stuff I have with new day opening gaps and the consequent encroachment levels of them, if they're wide, and new week opening gaps and their gradient levels. That's all I have. And maybe once in a while I'll have a previous day's high or low if it's really significant to me. And I grab it from the daily chart. And I just simply scribble down, what I think is going to be the draw right now for this hour and for the next hour and for the next hour. And then I keep record of how correct I am. And it tells me if I'm on side or not, if I'm in sync with the marketplace. And it's a good little drill for yourself to practice doing that each day. We're not reacting. Okay. We're not. You are anticipating. So as a trader, we're anticipating. We're looking for it. We want to see the gazelle get down by the watering hole and then it start to run. And we want to see if it's a pack of them, which one's the slowest one, because we want low hanging fruit. We don't want to work too hard to eat. So that's what we're looking for. What does that mean? The closest target that makes sense. So the market pulls off of that. Again, comes right back down. Trades back up to Tuesday's regular trading hours, opening range gap high, gravitates around that. Then uses Tuesday's regular trading hours, opening range gap high. Again, hits that, sells off. And in between these levels is no man's land. So any PD array that's not laying on top of one of these levels, I'm teaching how to find the right PD arrays. There has to be a key level at the right time. Key level, time, your PD arrays will work all the time. All the time, 100% strike right, boom, there it is, okay? So stop asking me why I'm choosing PD arrays like this and that. Why am I using that fair value gap? Because it's right over top of a gradient level at the right time, in deference to where I think the market's going to draw. If you have those three ingredients, you're going to have blue ribbon recipe results. It's going to come out beautiful. So the market comes and meanders around in here, rallies up once more, uses Friday's regular trading hours opening range gap low, propels it once more. Look at that immediate rebalance. I love that. As soon as that candlestick opened up like that, and it traded down, hammered that like that, that is one of the easiest. Get in there and go, and just reach for some measure of premium. Or if it's simply a small range like 20 handles, 15 handles, 30 handles, you don't even need a liquidity pool for that. Just that's your cookie cutter. If I can get 20 handles of that, boom, done. And there's where we're at here. So this is all simply this meandering around between two key levels. So even if you saw like this little thing here, like would you consider that a fair value gap to trade? No. Why? There's no level there. Just simply because there's a separation between three candles and one in the middle has an imbalance or what would be perceived as a imbalance doesn't mean anything to me. It's just a common gap. But it's an extraordinarily important gap if it's laying over top of a gradient level, if it's laying over top of a opening range level. Okay, so notice that we're using very specific price levels. They're not willy-nilly levels. They're not going to hide these from you. So we have this inefficiency here. What time of day is that? It's at 9:40. So that's your very, very first presented fair value gap during the opening range, first 30 minutes. Technically, it's 29 because you want to use minute 31. And the reason why, because there's very specific things that you want to use the 9:30 candle if it creates a fair value gap. I don't want to talk too much about it because there's so many things that could go wrong in the hands of someone that doesn't fully know what they're doing. So the rules are better served by following 9:31 to 10 o'clock in the morning Eastern time. The very first presented fair value gap that shows displacement, I think everybody would agree that this is displacement. This candlestick's low right there. That's the high of the fair value gap. And this candlestick's open. And the close here comes in at 928 3/4. So it's a half a handle or two ticks lower on the open on this. So that's the volume imbalance right there. This candlestick's closed, this candlestick's open. So that's a small little volume imbalance. So that's why I draw it down to that. Okay. So trading up into this here, you can be a short seller as it hits consequent encroachment, and your stop loss would be one tick above this candlestick's low. If it stops you out, wait for it to trade back below consequent encroachment. Any run back up, that's a fair value gap or trades into this up close candle here, that would be rejection block. You could be short there. So you could have used that. So in other words, say you went short here using first presented fair value gap and it went up here and stopped you out. No problem. No problem. You're not going to win every one of them. As soon as it went down below like it does here, that price right there, you would use that as your entry. That's your rejection block because it should not trade above this here and go above consequent encroachment if it is in fact weak. And there you go. You'd have an example here. Look at this wick. See that wick right there? What is it trading up to? Here's consequent encroachment. Doesn't even touch it 2 times. And then the candlestick goes down below the opening price there. What's the next candle going to do? Protraction. It's going to run. It opens, small little Judas swing, dumps. Where does it go to? Sell side. This is high frequency trading right there. That kind of stuff. Just like this is here. Change this day delivery, hits it, runs down. This candlestick trades below here, outside the body, the opening. So now markets has shifted, internals are shifted, bearish. Consequent encroachment of this wick here, Anything short above this candlestick's close with a stop just above consequent correction there is a nice sell. Low hanging fruit, low hanging fruit, and then the actual levels at Thursday, regular trading hours, opening range gap low. I want you to have these levels on your chart. Okay. Sometime this evening, sometime before tomorrow's trading, go back through price action and look at how many times price gives you very, very sweet little price runs that are just cookie cutters. They're just nice little runs. But the main thing is look at how the protraction of the candlesticks and the magnitude of the move is on the down close candles. All of these little retracements, okay, how long are they in duration candle wise? 1, 2, 3, couple of them, right? But when you start seeing the length and degree of how much price moves down, the bigger candles are on the downside. There's more candles going down than there are up. So order flow is what? Bearish. So you're blending two different things here. Where it is respecting and negating going in the upper half if it's bearish, or not if you're bullish, if it doesn't go down the lower half of the discount end of a PD, right? Inefficiency or an order block, something to that effect. We're looking at that characteristic of price action. And you see that with open, high, low, and close. It's a very simple procedure.